Welcome everyone to our latest edition of FX Talk, and it's a very special edition of the podcast today because for the very first time we're coming to you in video format as well as our usual audio form. The three of us, myself, Enrique and Roman, have all convened in Ebury's London office for the first time in a little while. It doesn't happen that often, so a great opportunity for us to come together and record one of these in person. And thanks to all of you currently watching in all our high definition glory. We hope this adds to the viewership experience, and perhaps this is something we can do maybe on a more frequent basis going forward. Yeah, absolutely. And we're going to do this slightly different today, as it is a special edition of the podcast. I thought we'd mix things up a little bit with the format. Believe it or not, we are halfway through 2022. Time flies when you're having fun. So what a good chance it is for us to look back on the last 6 months in the foreign exchange market, talk about our main highlights and the key things that we think are driving markets. We'll then look ahead and talk about what we expect during the remainder of 2022. And it's safe to say there's been no shortage of action in markets in the last 6 months or so. Concerns surrounding an increase in global inflation have dominated news headlines and been front and centre. That's done two things. First of all, it's caused central banks around the world to raise interest rates at a very aggressive rate, notably the likes of the Federal Reserve, which delivered a 75 basis point rate hike at its June meeting. It's also heightened concerns surrounding a possible slowdown in global growth, particularly raising concerns regarding recessions. In the FX market, that's resulted in a broadly stronger US dollar. The greenback has risen to its highest level in nearly 2 decades and rallied against pretty much every major and emerging market currency. Perhaps the key highlights among those in the G10 is calls for parity in euro dollar, which is not seen just yet, and we don't expect that to be the case. We've also seen the likes of the Japanese yen fallen to its lowest level since 1998. While among emerging markets, the notable outperformers have been the likes of the Russian ruble and those in Latin America, which have benefited from the commodity price rally, while the underperformers have been those in Europe, particularly given the economic implications of the war in Ukraine. But I want to hear from you guys. Perhaps you can start by giving me your main highlight or key takeaway from the year that we've seen in the markets so far.
I mean, to me, it's the inflation, and not just inflation, but the 180-degree pivot that we have seen from certain central banks, particularly the European Central Bank, but not only in their attitude towards inflation from what it was 6 months ago, from something that was expected to be a transitory phenomenon, that didn't really require much of a response to something that has become has come to dominate headlines, become the dominant problem worldwide, and driving markets both directly. The inflation numbers, drive what we see in currency markets, but also the response to that inflation, how fast and how high central banks are taking rates on the one hand, and second, how worried market participants are about the impact of these higher rates on a potential recession. That's definitely the highlight for the first 6 months. It's all about inflation.
What do you think, Roman?
Yeah, I think that the first 6 months of the year definitely reminded to us that regardless of the situation, unexpected things can happen and they can have a major impact. Unfortunately, in the first half of the year, from my Central European perspective, have been defined by a war in Ukraine. And in addition to the tremendous pain that it has brought to Ukraine and its people, it also had a lot of consequences to the economic situation worldwide. We have seen prices skyrocketing in large part because of that situation. We have seen issues in supply chains that were exacerbated by this. And we have seen a significant impact on emerging market currencies that were a consequence of those processes that I'm describing. So a deterioration in terms of trade in many countries in the EU, in Central and Eastern Europe, have affected the currencies market to a significant degree, have also pushed up interest rates in those countries, have pushed up the central banks to hike those rates quite aggressively. And to me, this is the defining element of the first half of the year, and unfortunately it's also likely going to be a defining element in the second half of the year. The war is ongoing, the price pressures that it caused are felt, and the issues with regards to food security, the issues with regards to elevated gas prices are unlikely to be resolved in the near term.
Yeah, I mean, it's safe to say it's certainly been a very, very hectic and busy period in markets. I think that's likely to continue in the second half of the year. More specifically, I want to talk about perhaps the currencies that have surprised you both this year. So can you pick either one currency or one region that has perhaps defied your expectations in the last 6 months? To start with you, Enrique.
Yeah, definitely the dollar. I did not expect this dollar strength, this dollar rally to near multi-decade highs. Even though, remember, our expectations for hikes of the Federal Reserve have been much higher than the market for a very long time. At the beginning of the year, we expected much more in hikes than the Federal Reserve itself expected, let alone market participants. We have been actually surprised by how quickly those expectations have been repriced upwards, and partly as a result of that, and also partly as a result of the Russian invasion of Ukraine, which was very difficult to foresee. That has resulted in a general flight to safety worldwide. I expected perhaps that while inflation would be an issue, I expected that financial markets and expectations for economic growth would be more resilient to it, but they have turned out to be. I still think expectations for recession are overblown. I think that the flight to safety into the dollar is not quite fully justified, but so far that's the currency that has surprised me the most this year.
Thank you, Aaron.
Yeah, I think that there were some surprises within the Central and Eastern Europe. Particularly the Hungarian forint was a big surprise for me. There was a long series of unfortunate events that has pushed the euro forint rate to the highest level on record, above the 400, and they have been just a series of varying and large impact events. So with regards to internal situation, the markets were spooked by an announcement of freezing of mortgage rates, of some tax changes that were perceived as negative for business, windfall tax. Also, the relationship with the EU is certainly on the rocks. Not only did Hungary not receive the acceptance of its recovery plan, contrary to Poland, but also the EU effectively triggered a procedure which could lead to a significant cut in Hungary's funds over the rule of law. Generally, also the situation in Ukraine war has impacted the relationships within the EU, and I think that Hungary was the country that has seen its image deteriorated because of that. Certainly not something that helps. Also, the thing that I mentioned previously, so the terms of trade shock also resulted in a rather significant current account deficit in Hungary, and generally, so as you can see, a lot of clearly negative events that have pushed the currency to a record low level. Right now, we are seeing some efforts from the central bank to stabilize the situation and to respond to weakening forint. Just recently, we had the central bank hiking interest rates, the reference rate, by 185 basis points, massive interest rate hike. So there is the prospects for the currency could be better going forward. Nonetheless, with regards to the first half of the year, this is the one that surprised me the most, and in a negative fashion.
Yeah, certainly with regards to the war in Ukraine, of course, no one in the market really was expecting. It wasn't on anyone's radar at the beginning of the year. It certainly caught markets completely wrong-footed. I think for me, before we move on, my pick would be the Chinese yuan. I think that's been the biggest, or at least one of the biggest surprises in markets in the last sort of 6 months or so. I think in particular the Chinese authorities' approach to COVID. I don't know if you guys agree, but I think it's been excessive. These continued lockdowns that we've seen, which have been among the most draconian that we've seen since the beginning of the pandemic, have been a big surprise to me, and that's clearly weighing on the Chinese yuan, which is trading much weaker than I certainly expected at the beginning of the year. I think we're going to move ahead now and look ahead to the second half of the year and what to expect in the markets in the next few months. Expectations and focus among investors, I think we can agree, is going to remain firmly on this global inflation overshoot that we've witnessed in the last few months, particularly its impact on both fiscal and monetary policy, and its impact on the global economy, particularly whether or not it will trigger recessions among the major nations. Markets are clearly concerned that recessions could potentially be on the way, particularly following the latest deterioration in economic data. We've seen some soft PMI indices and consumer confidence data in particular, which has concerned investors. Upcoming inflation prints, of course, will therefore be absolutely critical for investors, and markets will be keeping a very close eye on these, looking out for potential signs of an easing in inflationary pressures. Among the major nations, 8 of the G10 central banks have already raised interest rates in response to this overshoot in inflation in the Federal Reserve, 75 basis points in June, as I mentioned. Bank of England has raised rates for more than 100 basis points. There are a couple of outliers, the ECB and Bank of Japan, but the ECB is at least indicating that it's on course to raise rates in July, which markets we're watching very closely. But my question to you guys is what can we expect from these central banks during the rest of the year? Will they remain, or will they be turned potentially cautious given these recession concerns, or will we see an even more aggressive pace of hikes during the rest of the year?
It's hard to say. I think that so far they have given us every signal to think that they're going to continue to be very aggressive in fighting inflation, and they're going to continue to be willing to take risks when it comes to economic growth and financial markets in order to bring inflation under control. On the other hand, its expectations for future moves, especially out of the Federal Reserve, for instance, are already very, very aggressive. So it's going to be very difficult for central banks to, at least in the case of the Fed, to actually hike faster than expectations. I think that there's a lot of room for the European Central Bank to become a lot more aggressive. We're already seeing signs. Let's not forget that the European Central Bank is a bit of like a very small, large super tanker. It turns around very slowly, but with a lot of momentum. I think it has been executed in a hawkish pivot maybe for the last 3 months or so. That hawkish pivot is going to continue, and we're going to see, I think, the one place we're going to see hawkish surprises is no longer the Federal Reserve. It's going to be the European Central Bank. We're going to see 50 basis points a meeting with an outside chance of even more. And I don't think the markets are quite ready for that.
I'll tend to agree. How about your own?
Yeah, I think it will be largely idiosyncratic, and it will depend a lot on whether the country already started tightening policy or not, because we have some countries such as Brazil or Czech Republic that started hiking rates very early and also very aggressively. So in case of such countries, it would be hard to see a significant tightening going forward. With regards to countries that haven't yet started, such as the European Central Bank, I certainly would agree with Enrique, and I think that there is a likelihood that the markets will be surprised to the upside, even in the short term. But overall, I think that the moves will be largely idiosyncratic. They will depend on how much tightening was already delivered, and also on the individual characteristics of economies and currencies. If the external imbalances take place in an economy, if there is a pressure on currency, central banks will need to react or allow the depreciation of a currency. But in an environment where you want to stop inflation from becoming embedded, from becoming higher, they would likely tighten. So I'd say largely idiosyncratic.
I think that's a good point. Well, I think the view that we've held for a while is that with central banks and inflation data take the over as opposed to the under. I think that attention among these central bankers is very much turned to controlling inflation rather than necessarily supporting economies, and I think they'll probably go above and beyond in order to do so. in the second half of this year. So take the above rather than the under when it comes to interest rate hikes.
That's a very good.
Yeah. I think it's also worth noting that we are beginning to see signs of a downturn in economic activity and result of this increase in prices. The G3 PMIs, for instance, have begun to show signs of a downtrend. These are key indicators of economic activity. At least among the G3 nations, are printing just above the level of 50, which represents expansion, although are trending downwards, and indicators of consumer sentiment as well have taken a turn for the worse, which could potentially suggest that a slowdown is on the way. Equity markets have fallen in response to these inflation fears, while central bankers have aggressively revised lower their growth forecasts, which has provided a bit of support for the US dollar, actually quite a lot of support for the US dollar, which has far outperformed its peers in the last few months. But the big question now, I think, is do you guys think that these recession concerns are justified, or do you think that sort of technical recessions will be avoided? What are your thoughts?
I mean, it is true that this downward trend in the PMIs is a bit concerning, but overall, I still think that people are getting carried away with forecasting a recession. We have, first of all, in the consumer sector, we have a consumer that has plenty of savings accumulated during the pandemic. Employment is essentially both the Eurozone and the US. Most G10 economies are at de facto full employment with still labor shortages. And whatever consumer sentiment numbers may say, when the consumer has savings and a job, it's very difficult to see how consumption is not going to hold up well. And as to investment, yes, it's important to watch the PMI numbers, but there's still all the major PMI indices, which is the best leading indicator for business sentiment and activity that we have. All of them are expansionary levels, comfortably above 50. Fiscal policy is still very supportive. There's no sense of any fiscal pattern in the horizon. Government deficits are anywhere from 5 to 10%, depending on the economic area. Rates have gone up a lot, but still remain comfortably below inflation in most places. So you just have a lot of signs pointing to continued economic expansion. I would be very surprised if we saw a meaningful downturn over the next 2 or 3 quarters.
Yeah, and I think it's worth noting as well, these calls for technical recession, that is 2 consecutive quarters of negative economic growth. So we would need to see 6 months of deterioration in the PMIs, for instance, in order to justify that. And that's not what we've seen, certainly not yet anyway. It's still above the level of 50, denoting expansion. But Roman, what do you think about recession fears?
Yeah, I think recession fears, generally in markets, they tend to be very sensitive, and I think they are overreacting to the situation. Nonetheless, with regards to recession, I think that it will depend a lot on the country, again, and also on the definition of recession. If we take the technical definition of recession, we can easily expect it in certain countries, such as, for instance, Czech Republic. I think that there is also some risk that Poland will enter a recession. With regards to main economies, we already had a negative period of growth in the US in the first quarter. So if we were to get a negative growth in the second, we would technically be in a recession in the US. So I think that this may happen. Nonetheless, that being said, with strong labor markets and with unemployment rates very low and unlikely to shoot up significantly, with certain issues resolved, such as the COVID, the pandemic issue that has negatively affected the supply chains, economic activity, and also pushed up inflation, and made the large shocks hopefully behind us. I don't think that we are going to see a period of significant gloom that will drag on with us for years and that will be particularly painful. I think that even if the market is correct about a possibility of a technical recession, I don't think that it will be the end of the world, just a step in a normalization process, normalization of the situation. Because although right now we are not in a recession, we certainly experience some difficulties, cost of living crisis, and I think that a slowdown in economic growth could be actually favorable in this context. It could help bring down inflation, and just hopefully this will not be too significant of a slowdown.
I think it's a very fair point, and I sort of do agree with both of you guys. I do think that these concerns of recession perhaps a little bit overblown. As we've been saying, consumers appear very resilient, labour markets are strong. I think there's a degree to which the market is underestimating perhaps the amount of pent-up demand that is still in markets. I think there is, or among consumers, I should say, I think there is still a degree of people wanting to make up for lost time. You know, we've had a prolonged period, certainly last year, where we're in lockdowns or prolonged shutdowns. I think that people or consumers are willing to spend that little bit more money in order to do or return to doing those things that they did prior to the pandemic. But we'll see, and we'll be keeping very close tabs on this, certainly in the next few weeks and months. We're going to finish things off now with a little interesting exercise. I thought we'd each pick one currency that we think will outperform in the second half of this year, next 6 months, and one currency that we think will underperform relative to its peers, with a short rationale as to why. Perhaps I can kick off with my outperformer, and I've gone for the Australian dollar. I think the Australian dollar is due a bit of a rebound in the second half of this year. For one, the Reserve Bank of Australia has been a little bit cautious when it comes to raising interest rates among its peers. I think that's going to change significantly in the second half of this year. In fact, I think the RBA will raise rates more aggressively than pretty much any other central bank in the G10, which should help support the dollar. Commodity prices remain high, and if anything, will move higher in the second half of this year. Again, a positive for the Australian economy, given its dependence on commodity exports. And generally, I'm positive on risk sentiment during the remainder of this year, which again should help support the Australian dollar, given its high risk status. But how about you guys? Outperformer to start with. What do you think?
Outperformer. I think the Swiss franc. I think that the change of heart of the Swiss National Bank that we saw a couple of weeks ago, that shock hike of 50 basis points that nobody was expecting. Even more importantly, that turnaround in the currency policy. Let's not forget that for 10 years, the only thing that kept the Swiss franc from appreciating, given their massive current account surplus that Switzerland always has, was the Swiss National Bank constantly selling its own currency, month after month, during most periods, accumulating foreign reserves. Now they're telling you that they're no longer going to do that, and that in fact they almost welcome the appreciation of the Swiss franc as a way to fight inflation. That's a sea change in attitude from the Swiss National Bank that I don't think is in the price yet. I think that markets tend to overreact to small changes and underreact at first to regime changes. And what we've seen in Switzerland is a complete change in mindset from the Swiss National Bank, and I think there's still room for the Swiss franc to go up.
It's a very good pick. What's your choice for your outperformer, Roman?
My choice would actually be the Polish zloty.
I knew you'd pick that one. It's a bit of a domestic bias.
It's balanced. It's risk off versus true risk on.
Yeah.
Balanced set of recommendations.
That's true. That said, I would say that I agree with both of you about your picks. But with regards to the zloty, I think that we are going to see some further tightening in monetary policy, probably more aggressive than I expected earlier. The economic situation still remains rather favorable, particularly looking at the labor market. This is one of the best labor markets that Poland has ever experienced, and this should cushion any downturn. Also, Poland and EU relationship is improving. We have seen that the European Commission approved the Polish recovery plan, so we might see funds being delivered to Poland, which should help with investment growth just at the moment when the economic situation is set to slow. So those factors suggest to me that the Polish zloty should be doing quite well going forward, and albeit possibly not to the extent that I thought previously. There are a lot of risks on the horizon, some domestic risks, including the upcoming elections in Poland, We also have the risk with regards to the energy security in Europe and overall how economic situation can react to any disruptions. So I'll be mindful of those risks, but the Polish zloty would still be my pick.
And now, in terms of underperformer, what do we think to underperform the next 6 months of the year? Enrique, maybe you can start.
Well, I'll pick the easy one, the US dollar. I think that this, I think that one point that all three of us agree on is that recession fears are excessive in the market. And the main beneficiary from these recessionary fears has been the US dollar, especially because the other typical safe haven, which was Japanese yen, has not performed well because of the dovishness of the Bank of Japan, which is a separate issue. I think that once the market comes around to believe that recession fears are excessive, that if we see a pause in growth, it will be something technical, not really a deep downturn. Risk sentiment will rebound. The U.S. will lose its safe haven asset, safe haven status, and also we'll come to realize that whereas it's going to be difficult for the Federal Reserve to hike even more than the market is predicting in other places, especially in Europe, European central banks, not just the ECB, there's still room for markets to bring up their expectations of both of the pace of hikes and the steady level of rates into 2023. So I think the US dollar has potential for underperformance here.
Yes, I mean, certainly given its very elevated levels at the moment, it's very difficult for it to continue to post additional gains above then. Raymond, underperformer.
I would actually be looking at Asia and particularly at Indian rupee. We are seeing that the currency is already succumbing to depreciation. We see some external imbalances elevated. India is a net energy commodity importer, so the current situation is not favorable for the country. Interest rates in India are relatively low, and the prospects for their increases are certainly not as significant as in some other countries. We are unlikely to see something that has happened in Latin America or Central and Eastern Europe with monetary policy tightening there. Also, the Central Bank of India is generally a bank that intervenes in the currency market, but its interventions have yet to stop the currency from depreciating, and I think that they just might be to limit the pace of the depreciation and not to stop it entirely. So I think that the Indian rupee prospects are not particularly good.
Yeah, I mean, my pick is maybe a little bit of a left field one. I've actually gone for the Japanese yen, which is already trading at very weak levels. It's sold off more than pretty much every other currency in the world in the first 6 months of the year. But I think there's a very significant lag from the Bank of Japan. We've already talked about it. It doesn't look like it's going to raise interest rates anytime soon. It's going to continue to weigh on the yen during the remainder of the year. So if we do start seeing a bit of a rebound in the yen, I would suggest that perhaps that might be maybe unsustained in the longer run, given this very dovish stance from the Bank of Japan. Thank you all very much for joining. We hope you enjoyed our very special edition of FX Talk. Don't forget to catch our latest episode in a couple of weeks' time, and be sure to subscribe to FX Talk on your favorite podcast app.